Disclaimer: this video is created for educational purposes only and does not constitute financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. Let's be honest, for most new investors, index funds and ETFs sound almost identical. Both let you invest in a bunch of companies at once, both promise diversification, and both are considered smart, low-cost ways to grow your money over time. But here's the real question: if they're so similar, why do both exist, and which one is actually better for you? In this video, we'll break down the real difference between index funds and ETFs, how they work, how they make you money, and when you might want to choose one over the other. Let's start with what they have in common. Both index funds and ETFs are built around the same basic idea: tracking a specific market index. That could be the S&P 500, the NASDAQ 100, or even something more global like the MSCI World Index. Instead of buying individual stocks, you buy one single product that owns tiny pieces of all those companies. It's like owning the entire market in one move. Now, here's where they start to differ: how you buy them. An index fund is what's known as a mutual fund. You don't buy it on the stock exchange. Instead, you invest directly through the fund provider. Companies like Vanguard, Fidelity, or BlackRock. You send them money, they process your order, and by the end of the trading day, you own your share of that fund. An ETF, on the other hand, trades like a stock. You can buy and sell it instantly during market hours using a regular brokerage account, just like you would with Apple or Tesla shares. The price of an ETF moves throughout the day based on supply and demand. That flexibility is one of the biggest advantages ETFs have over traditional index funds. But that flexibility also means ETFs behave slightly differently. When you buy an index fund, you always get the day's official closing price, the net asset value. With an ETF, you can get slightly better or slightly worse prices depending on when and how you trade. Now let's talk about minimum investments. Traditional index funds often require a minimum amount, sometimes $1,000, $3,000, or even $10,000, before you can invest. ETFs don't. You can buy just one share, or even a fractional share for a few dollars. That's why ETFs are often more beginner-friendly. Then there's the topic of fees. Both options are low cost compared to actively managed funds, but ETFs typically have the edge. Because ETFs are passively managed and often structured more efficiently, they tend to have slightly lower expense ratios. For example, the Vanguard S&P 500 Index Fund might have a 0.04% fee, while the ETF version costs 0.03%. That difference sounds tiny, but over decades, it adds up. Next up, dividends. When the companies in your fund pay dividends, both ETFs and index funds pass that money on to you. The only difference is how and when they do it. ETFs usually pay dividends directly into your brokerage account every quarter. Index funds, depending on the provider, might automatically reinvest them for you, which is great for compounding, but less flexible if you prefer to control your cash flow. One of the most overlooked differences between ETFs and index funds is tax efficiency. This is where ETFs really shine. Because of their unique creation and redemption mechanism, ETFs can swap shares internally without triggering capital gains taxes for investors. In simple terms, that means you're not taxed until you actually sell your ETF. Index funds, however, sometimes have to sell securities inside the fund to meet redemptions. And that can create taxable events, even if you didn't sell anything. For long-term investors, that extra efficiency gives ETFs a clear advantage. However, index funds have their own strengths. They're simple, automatic, and perfect for long-term hands-off investing. You can set up automatic monthly contributions, no trading, no decisions, no emotions. The fund just quietly grows over time. For many people, that simplicity is worth more than intraday flexibility. So, let's summarize the key differences. ETFs trade like stocks. You can buy or sell anytime during the trading day. Index funds trade only once per day. ETFs usually have slightly lower fees and better tax efficiency. Index funds make it easier to automate your investing. ETFs are more flexible, while index funds are more set and forget. At the end of the day, both options are excellent. The truth is, whether you invest through an index fund or an ETF, you're already ahead of most investors because you're focusing on broad diversification, low fees, and long-term growth instead of chasing short-term wins. So how do you decide which one is right for you? If you prefer automation, no trading decisions, and a long-term savings plan, go with an index fund. If you want flexibility, real-time trading, and maximum tax efficiency, ETFs are your best friend. And here's a little secret. Many fund companies now offer both versions of the same product. For example, the Vanguard S&P 500 ETF, ticker VOO, and the Vanguard 500 Index Fund, ticker VFIAX, track the same companies, deliver nearly identical performance, and differ only in structure. So whichever one you choose, your money is essentially working the same way. In the end, the best choice isn't about picking sides. It's about picking what fits your strategy. ETFs and index funds are both tools, and like any tool, what matters is how you use them. If you found this helpful, hit like and subscribe to Money Mindset. We post new videos every day to help you understand money, investing, and the systems that shape your financial future. Comment below and tell us which one you prefer, ETFs or index funds, and why.